Hey guys, this is the Real Estate Podcast, and this is your host, yours truly, Matt Teifke. Real quick, before we dive in, if you don't mind, please make sure to subscribe to our channel. We want to get the message out that real estate can be for everybody. We want to share the entrepreneurship that we're learning along our journey. So before we dive into the episode, please make sure you share with your friends, and we want to continue to add value. So thank you guys, and let's dive right into the episode.
The thing is that the Federal Reserve is politically motivated to keep their finger on the money printer button. And the only thing that stops them is their congressional mandate from Congress to keep inflation in check. And lo and behold, their finger has been on the button for really the past 10 years and then escalated in the past 2 years, whereby 40% of all the dollars in existence were printed last year. I mean, that's a wild statistic.
All right, it's showtime. Everybody, welcome to the Real Estate Podcast. Your host, Matt Teifke here, and I'm super excited. We have a guest that I actually went to school with at A&M through the Masters of Real Estate program. Appreciate y'all tuning in, and we're going to dive in right now. Harrison Hunt, appreciate you coming on, man. You're with the Originations team at Capital One Multifamily Finance. We both went to A&M together, and you're living out in New York and doing some cool things. So I appreciate you joining, man, and thanks for coming on.
Yeah, appreciate you guys having me. Thanks for reaching out.
Yeah, absolutely. So what we like to do is dive into people's backgrounds, and if it's all right with you, if you could kind of walk us through just your business career and how you got to where you're at today. And then you sent over some really cool topics, which I think will be valuable. It's a little bit different than a lot of people see and experience in the real estate industry. So I think it's going to be great for the listeners. But if it's okay with you, man, just kind of walk us through how you got to where you're at, living in New York City and doing what you're doing.
Yeah, sure thing. So my name's Harrison Hunt. I'm actually a native Texan. So I'm born and raised in Corpus Christi, so South Texas, home of Whataburger, and then made my way up to the real estate program at Texas A&M. Did undergrad there, and then stayed on for their Masters of Real Estate program, and that's where Matt and I actually crossed paths. So got to know you through that program, and I've been up in New York for probably 6 years now, so it's been a while since we had a chance to reconnect. So this is great.
I'm excited, man. So go ahead, keep going.
Yeah. So I studied at the Masters of Real Estate program at A&M. Ended up getting I was looking for jobs in Houston and Dallas, honestly, and then just kind of this serendipitous opportunity rolled across, the horizon for me to move up to New York City, and, never been there before, and just said, hell, let's give it a try. So I've been up here ever since. Well, I'm in Texas right now, so back in the homeland, but yeah, so I work on a little bit about kind of what I'm doing these days is I work for Capital One in their multifamily finance division, and we specialize in what's known as GSE lending. So that's Fannie Mae and Freddie Mac, which those names are kind of familiar to everyone, but huge players in the single family lending space, but also gigantic players in multifamily lending. Every year they contribute around 50% of all the multifamily loans that are closed in the nation. So those all get closed through banking partners, like Capital One or Wells Fargo, Walker Dunlop are kind of the big names as well. So yeah, just big industry giants that kind of touch everything, single family and multifamily. And the team that I've kind of specialized in is the affordable housing component of multifamily. So that's any multifamily property, anywhere from 20 to 500 units, really kind of touch anything, but specialize in helping our clients, being either asset managers, real estate funds, or developers, figure out their financing needs for properties that have low-income housing tax credits, affordable housing components. So that's a very quick, run through of what I'm doing now. But I think a couple of bullet points later, to, diving into what affordable housing is, et cetera. But I'll kind of stop there for the summary.
Yeah, man, I love it. That's great. And it's fascinating to me because I actually went to school in Corpus, and Corpus is a different world, and obviously New York is as well. And from my perception, I haven't lived in New York, but I feel like they couldn't be different. And so it's like growing up there, now living, College Station is its own animal. They're all so very different. So it's fascinating just on that component of like where you've lived. What you did, we all did the internship when we were going through that MRE program. What was your internship when you were going to A&M?
Yeah, so my internship was I did a summer in Houston, and I was working for JP Morgan Chase in their balance sheet lending team. So they were doing a lot of it was multifamily mostly. We did a little bit of office, a little bit of retail, but it was probably 70% multifamily. So I was on their lending team there, and it's just it is a different credit box, right? Like they are lending out the bank's balance sheet money. So a lot of the product types they were looking at were Class A multifamily, very risk averse. They were doing new construction loans too, but a lot of it was it was driven by who was already a big client of the bank, right? In lending, in I guess the traditional lending world, a lot of you do a lot of like loss leading products to draw in larger deposits from your banking clients, right? So your cash operating accounts, we want you to park those at the bank, right? Because we kind of generate earnings on those deposits. Um, so all that to say, it was great to see beautiful looking Class A new construction buildings, but the real estate analysis wasn't all that tough, right? It's just, wow, looks like a great product. It's definitely going to work as long as we have your deposits. Like they're checking all the boxes, like they're doing their due diligence, but it wasn't as I guess exciting from that perspective.
Yeah.
But it was a great introduction to how credit works. They have a great team there. Loved working with them, but yeah, it was on to other things. I wanted to, I guess, specialize in something, get a little more into the nitty gritty of working on real estate that's Class B, Class C, acquisition rehabs, and a little bit less driven on, hey, this is a low loan to value, and we have this great credit that can backstop any losses, right? That's one thing I find exciting about kind of the industry I'm in now with affordable housing is it's not always pretty real estate, and you got to sharpen your pencils, and the people that can tackle those problems and acquire something that might be underperforming or needs a new capital injection and renovation. It's it's just it's something that appeals to me. Yeah.
Yeah, that's what I was going to say. So one of your bullet points that you had on topics was to specialize yourself. And from my perception of you, is you really like the analytical, like you really like the spreadsheets. And I could be wrong, but like you're really good at that stuff. And obviously being at JP and then doing what you're doing, that would tend to seem to be true. Um, where some people like me, I like kind of more brokerage, entrepreneurial. Not that what you're doing is not entrepreneurial, but it's a different mindset and skill set, which is super valuable. When you
Yeah.
said specialize on these topics, is that something you were alluding to, like dial in at what you're really good at and kind of have that one thing?
Yeah, exactly. And that's something that's kind of resonated with me or been kind of a personal mantra is that, the world is insanely competitive, right? Like the world is flat as far as competition goes, right? And so you either need to, you know, the one kind of way around that, from my perspective, is to just specialize in something that people not might not be aware exists, right? Because I went through all of college, studying finance, and then the real estate program, and we never really touched on affordable housing, right? And like it was, might have been mentioned once or twice, but I kind of, like I said, it was unexpected that I ended up in this industry, but um, it's definitely kind of an endless kind of there's an endless amount of complexity to it because it's dealing with this interesting public-private partnership or between the government and private developers. So yeah, it was a way for me to get my heads in the weeds on like the analytical aspect of it. I definitely prioritized, going down a more, I don't know, just numbers crunching approach to real estate.
Yep.
But it's funny now that I've been in the industry for, I guess, like 6 years. Um, it, every single kind of industry eventually comes back to sales and relationships, right? And so, like, I've after kind of kind of establishing my comfort in the industry from the analytical side, eventually you graduate beyond that and you hire people to do the nitty gritty work for you so that you can get back to that relationship driven business. So that's a personal challenge that I'm working on expanding that in myself. And
Interesting.
you guys are experts on that aspect of it. So definitely I guess respect you guys for the brand that you guys have built and the way that you approach the relationship side of the industry as well.
That's cool, man. Thanks for saying that. And very interesting. Like, is you graduating to that step, is that like something that you want to do, or is that just the natural progression of what you're doing? Like, I'd love to kind of dive into that and what that may look like for you.
Yeah, sure thing. So it's kind of a natural progression. There's a lot of different avenues that could unfold. One of them is to be kind of like a deal manager, a transaction manager, like as deals are coming in. So, like I said, one thing. Let me take one step back. One thing about specializing and being in affordable housing is that a lot of our business is just driven by word of mouth. A lot of our clients, see, we have a ton of repeat clients who, once you figure out this complex process of closing a loan with us, they want to work with us again, right? And then those referrals kind of generate other, more business. So there's been, we've been kind of turning deals away often. We're just kind of too busy. There's only so much we can close, right? And so I've in the past 5 years, I've really just been focused on getting deals closed, navigating complexities, solving problems when they pop up in the closing or dealing with regulatory agreements. And that is what I've gotten good at. But, there's an eventual goal of, okay, now that I understand this process, I can either just be a transaction manager and manage a team of analysts to get deals done as they come in, or it would be branch out to a new shop, or even just within Capital One to get my own kind of generate additional deals kind of from scratch. So there's kind of this transition period of which path you want to go down. And I think anyone who gets into originations has the originations mindset. That's why they're in it, right? That's why I originally got into real estate, was because I thought it was a perfect melding of analytical skills and interpersonal skills. The people I really looked up to who are successful in real estate had a great combination of both. So that's kind of the logical path for someone who goes into debt originations, is you spend your time grinding through the analytics until you understand it well, and then you go off into your own, generate your own book of business. And like I said, I've been in a very privileged position over the past few years that our book of business has been kind of self-sustaining. But appreciating that might not always be the case.
Yeah, yeah.
So
That's cool, man. And I 100% know that you basically use what you were taught at that Masters of Real Estate program all the time, which is interesting because I really don't. But the thing that I kind of struggle with is, like, I think I do subconsciously. I just might not realize it. Like, I know it was super valuable, but I'm not doing a
yeah,
lot of the, spreadsheets and net present value and IRR. But like, I'm happy that I did, and it gave me a really good confidence that I do feel like I can talk real estate with anybody. But you're literally just using that same stuff and then building onto it.
it's funny because I kind of went through a transition period in my own understanding of the value of the real estate program, because whenever I first got my job, I didn't think I was using any of it. of what I learned at the MRE program, which is funny because I definitely went in a more analytical route or a more numbers driven route. And when I first got the job, like 2 years in, I was like, oh, I'm not using anything I learned in school. But as time has progressed, I realized that, like, you know, taking the appraisal class, was useful, even though, in my first 2 years, I wasn't having to generate my own discounted cash flows or, do net present values. Like, lo and behold, it has kind of creeped in. And as I've gotten more into my career, I appreciate, like, I guess the best way of putting it is by the time I was through the program, it all seemed pretty rudimentary. But I have to remember how ignorant I was at the beginning of the program, of the real
Right.
estate program. Um, so yeah, it's interesting that you say that you haven't used much in your day to day from that program, because I kind of felt the same way. It wasn't just until hindsight where I think honestly it's like anyone. If anyone wants advice on like how do you break into the industry, I would still say, go to a real estate program if you don't have a good network of people, right? Because that's what I think the real benefit of the program was just getting exposed to, speakers coming in, talking, not unlike this podcast, right? Like just getting a different perspective of, what's a debt shop look like? What's an equity shop look like? How, these are what we think about when we're writing an appraisal. Even if that doesn't filter into your daily actions, it kind of builds your understanding of just how the world works. So anyway, that's
Yeah,
my
yeah,
kind of
no.
thought on the
Well,
program. Yeah.
and just to talk on that a little bit more, I agree, and you know, for me, there's something really big to the confidence. Like, I really, when I say that, like, I feel like I can talk real estate with anybody. Like, that means a lot to me. Where if I didn't have that, I might feel sometimes like, oh man, I'm out of my league. Like, I don't know what's going on. But I
Yeah.
do. I pretty much get it, at least at a broad level. I understand all these components, which that confidence is huge.
Yeah.
And what
Agreed.
I tell people, my opinion is like, when people ask about it, I say, if you think you want to be in the real estate business for a career and you want to do it for the long term, then I 100% recommend it. If you can do it and it works out. So that's where I fall on that spectrum as well. Um, but back to like these notes that you sent, man, I love it because part of the goal of this podcast is to get true value out, hear people's stories and get value to listeners and entrepreneurs. And I really like this one. You put what drives value, cap rates versus debt service. And then you put quotation mark, people buy payment, not price. And I'm not fully understanding that, but I'd love to hear kind of your thoughts on all that.
Yeah. And this is so you're right. That's one kind of I put that in the bullet point of like trends that I think are kind of important or meaningful to like get a handle on and like understand. And there's this obsession with understanding value from like a kind of a physical standpoint of, oh, you're the amenities are great, or the granite countertops, or whatever it is. There's a real kind of intrinsic value from that perspective. But what a lot of people don't appreciate, and you see this kind of from the debt side of the industry, is what really drives value is access to capital. And we've kind of seen that over the past, 2 years. It's kind of like everyone has it in their mind that like, oh, interest rates are, zero, or interest rates are 2%. This would be a great time to buy. But then they suddenly get hit with the realization of like everyone's trying to do the same thing. And so all of a sudden you're in this kind of frenzy of, people bidding up, asking prices. And it can come as like kind of a surprise, or as like, oh, something's wrong, there's something wrong in the market and the market's too hot. But there's kind of a fundamental driving factor, which is that we get obsessed over prices, right? Prices of real estate, values of real estate. But you have to think about the thought process of the people who are driving up the prices, which is they're not thinking of a $4 million outlay. They're thinking of their debt service, at least in the institutional world, right? Like,
Sure.
and so as interest rates get closer and closer to zero, it's not surprising that asset prices skyrocket, because it's you bid up the price until your payment becomes painful, right? And
Got
so
it.
it's a larger commentary on how important um, the debt capital markets are to value. And if you don't have a handle on that, you it, it can be surprising how values end up being determined or how they react to what's going on in the debt markets. Um, and that kind of feeds into a broader conversation of, the Federal Reserve, and you need to have a handle on what interest rates are doing. But I think that's kind of an easy kind of soundbite or an easy nugget to latch onto, of like, it really, value is driven by interest rates. um, and for instance, like, we have a product in our suite of loans. We, like I said, we do Fannie Mae and Freddie Mac. That's our bread and butter. But that'll get you up to 80% loan to value on an acquisition or refinance, whatever. But there's other products out there that we look at, which are FHA loans, which are really popular in single family, and for like veterans, they have like certain qualifications. But there's also a multifamily component where you can get FHA financing. But the only reason I bring that up is because you can finance, you know, 90% of your acquisition, your loan to value through FHA financing, and then in some cases you can get up to 97% in the single family space. So you think about that, and you say that if 97% of my uh, capital outlay is coming from my debt, and my debt interest rates drop, 0.5%, what does that do to the amount of real estate I can afford to buy? And there's a kind of this multiplier effect, which, I think people are aware of that now that, real estates have, interest rates have plummeted to zero and values have skyrocketed. It's not just an aspect of like, oh, during quarantine, everyone wants to buy their own home. It's an aspect of the capital markets and kind of that money is free, right? We're living in a time where money, at least for large corporations, we can borrow at 2%, for a 30-year term. So it's just an interesting aspect that I think that you don't have to be an expert in it, but just understand that that's an element of what's driving the valuations that we're seeing today.
Yeah, that's cool. I love it, man. People buy payment, not price. I get it. Totally
Mm-hmm.
makes sense. And then you alluded to Federal Reserve, and if you don't know what's going on with the Federal Reserve, you're kind of flying blind within real estate. What's your take on that, and like how you follow it and stay up to date with what's going on, and I guess plan for what changes might come?
Yeah, and this is, a huge topic for sure, and I could, sit on a soapbox for hours about this. But yeah, and it's very related to the comment I just made about, interest rates driving value. And I think that this is, it's something. So like, okay, if you run like a waste management company, and you're killing it in that, and that's your small business, it doesn't really affect you like what the Federal Reserve is doing, what interest rates are doing. Like if you own a paint store, it doesn't really affect you. But if you work in, you know, anything investment related, so talking about like real estate investments, or if you're a real estate asset manager, or maybe you're in investment sales as a broker, anything that touches asset prices, I think that understanding what the Federal Reserve is doing is a core kind of mover that affects what you work in. And I think that it's so there's this quote that I like, and it's by Ray Dalio. He has this book called Principles, which um, Ray Dalio is this big hedge fund manager, one of the top performers in, I guess, like the past decade. But he has this one little quote that I really like. He's very analytical mindset, and he said, there's two ways to generate success or generate an outcome that's desirable. And one is having an accurate view of how the world works and making decisions based on that. And the other one is luck. And or you could say like, blessings that accrue to you, or like, that God's got your back and he's blessing you every day. But there's only one of those that you can control, which is the first one. And so I think a huge component of understanding real estate and asset management and asset prices is understanding who sets the interest rates. And I remember, like I said, I went through, 4 years of undergrad finance and then, another year and a half of the master's real estate program. And it kind of boggles my mind that this never came up. Like nobody ever, it might have been glossed over in one chapter of a finance class, but understanding that the interest rates are set by a institution, the Federal Reserve, that the word federal is doesn't mean it's part of our government. It's just the name. It's run by non-elected officials. It's a weird public-private partnership where half of the board members are from private banks and half of them are from, the Federal Reserve, kind of like a government agency. But it's a lot of people take interest rates as a natural reaction to market preferences, right? Like it's a risk on appetite or a risk off, and that's what drives interest rates. But the core mover really is our economy is decided by what the Federal Reserve does. If they raise interest rates to 5% tomorrow, our economy collapses. Like that's not lost on anyone. But that's a wild proposition, and it's a large kind of, this doesn't impact your day-to-day decisions with real estate, but you need to have an opinion of what you think the Federal Reserve is going to do and what political pressures are being placed on them. Because it's what drives our economy, right? Like whenever COVID happened and the stock market tanked, everyone's familiar now, like the money printer, right? Everyone like money printer go burr. That's like a common, meme, and people are at least paying attention to it now. But it's something that I guess didn't, not that I'm smarter than anyone, it's just that I bothered to look into like, what is the Federal Reserve and how does it work? Back in like 2018, and I've been screaming from the rooftops that like inflation's coming, like the money printer's never going to stop. And then COVID happened, and I was like, oh, like damn, this is go time. Like the money printer's about to start running, and it's like I said, it's not that I'm smarter than anyone or I predicted it. It's just that it's information that's out there that everyone takes as a given, that
Mm-hmm.
interest rates move around and it's the business cycle. So I would just encourage people to take a look at what the Federal Reserve is and how it dictates our business cycle. And like I said, this is a very complicated topic that might not improve the daily, or it might not give value to your listeners, if they're not in kind of an asset management or really trying to hone in on what drives value of, investment properties. But it's pretty much the only thing that I think matters in our economy. Is I said that this was the joke I said in 2019 of like, I can't remember how this came up in conversation, but it was, I think the most powerful man in the world is the guy who decides what gets exempt from the CPI calculation. So the guy who calculates inflation is the most powerful man in the world, right? And it's a board of people, but the thing is that the Federal Reserve is politically motivated to keep their finger on the money printer button. And the only thing that stops them is their congressional mandate from Congress to keep inflation in check. And lo and behold, their finger has been on the button for really the past 10 years and then escalated in the past 2 years, whereby 40% of all the dollars in existence were printed last year. I mean, that's a wild statistic.
I didn't know that. Yeah.
Yeah. I mean, you look at the Federal Reserve's balance sheet and you see, this little increase from 2008 when they first turned it on. And then it's kind of been on ever since. And they've been talking about getting rid of it. And they've been talking about getting rid of it. And it never has. And then COVID hits and it just goes straight vertical. And all 40% of all the dollars that exist were printed last year.
Wow.
And to think that that wouldn't have an impact on asset valuations is absurd. So like, you see this headwind coming and you say, oh my God, the stock market's going to go parabolic. Asset prices are going to go parabolic. Like I've got to throw, and everyone's, panicking when COVID hits and you realize the money printer is about to turn on to like save the economy. And what have we seen? We've seen inflation was stagnant for the first year, right? Because none of this had really trickled through because all the money was getting allocated to large institutions, and CPI doesn't track what large institutions buy. Large institutions buy assets, and asset prices are where you saw inflation. You saw every asset in existence go up 30%. And and everyone's like, oh, well, the money printer's not bad because CPI hasn't gone up. And then lo and behold, this year we hit 7%, 8% inflation, which is the highest on record. And that doesn't include things like what people are really, what affects the average day consumer. Like, it doesn't include the CPI, our measure of inflation doesn't include home values. Okay, well, those have gone through the roof. It doesn't include the price of healthcare, or it doesn't include the cost of, it includes the cost of oil, but not energy. And so there's all these things that they not to say they manipulate the data, but the CPI doesn't track things that have gone parabolic in price. And like, how lucky is that? So, like I said, I could sit on the soapbox for hours and talk about it, but it's this surprising core driver of our economy. And in my mind, it's the only thing that matters. If you are, and especially in real estate too, because it's such a long-term perspective of like, I want to buy this asset and I'm going to hold on to it for 10 years, right? So it might not be the fact that like, I think money printing is going to continue next year. It's like, over the course of 10 years, do I think asset prices are going to keep going up forever? It's either that or it all collapses, and then we have to have bigger problems to worry about. But it's this weird kind of one-way gate where you slowly appreciate that the money printer has become a political issue. And Trump was the first one who started pressuring the Fed, because Trump cared about the stock market and his approval would go up if the stock market was doing well. He was the first one who bullied the Federal Reserve and said, like, why aren't you printing more money? And prior to him, there was always kind of this separation of like, presidents should never try to influence the money printer. And now that it's been done, Biden's doing the same thing, trying to monetize his huge spending bill. And the way they're going to pay for it is through a slightly different avenue, but it's through the Federal Reserve buying treasuries to pay for government spending. So, but it's not a Republican Democrat thing. It's just there's a political pressure to never stop the money printer, because if it stops when you're in office, like the economy is going to collapse. So I don't know.
That's great.
There's no real conclusion, but like I said, I'll stop there because
No,
I'm
man.
obviously very passionate about it.
I really like it. I mean, I'm learning just just listening. I'm sure other people are enjoying it, and I'm just sitting here thinking we're gonna have to do another episode on just the Federal Reserve. I mean, it's really fascinating, and you're right. Like, a lot of people don't really track it that closely. I don't know if I have ever heard of this book or read it, but I read this book called The Creature at Jekyll Island. Have you heard of this?
Oh yeah, I've heard of it. That's where the Federal Reserve was established, basically.
Dude, I'm gonna send you this book because of how deep you're into this. Like, I really want to know what you think about it, but it's fascinating because it's the history and how it was created, and I don't know if it's true or not. It seems like it is, but it's just talking about like it was some really, really wealthy people back in the day, and they snuck off to this island and literally created it. And it talks about like this is a legal cartel, and that's what they say.
Absolutely. It's so funny that like anytime you start talking about the Federal Reserve, people clam up because it used to be so, especially before the money printer turned on. Like, you talk about the Federal Reserve and people are like, I don't know, Ron Paul was angry at them for some reason, and then you're probably a conspiracy theorist. Right. But it's funny because like this is all published on the Federal Reserve website. This is how we work. It's not a secret story of how they were established. It was, it was a weird backroom dealing, but that's the history of the Federal Reserve. That's how it was established. And you need to send me that book because I've heard of it before, and
you'll love it. Yeah. I think I've got a lot of notes and all this stuff in it, but I'll send it to you. I think you'll really enjoy it. I want to hear what you think about it.
And the last thing I'll say is I kept the conversation as close to what I think is pertinent to real estate, which is asset valuations affected by the Federal Reserve. But like I said, I'm fascinated with just understanding how the world works. And I think that the Federal Reserve is one missing piece that a lot of people don't appreciate. But there's this fascinating aspect of geopolitics too, of the Federal Reserve. There's this thing called the petrodollar, which I'd heard of before. I didn't really appreciate what it was. But why is the Federal Reserve so important from another aspect is The petrodollar is a term to describe this agreement that Nixon made, or Nixon, or it was Reagan. I can't remember. But it was an agreement that the U.S. made with Saudi Arabia in the 70s, which said, and OPEC, any barrel of oil that OPEC sells is priced in US dollars. So if they would sell a barrel of oil and Russia wants to buy it, Russia has to buy US dollars first, which doesn't seem like a big deal at first, right? You say, okay, well, that just seems a little unnecessary. And it'd be great to have one unified price for oil. We don't need to track oil and the renminbi and the yuan and all these different currencies. The interesting element of that is that to hold US dollars, you have to have an account at the Federal Reserve. This is how every commercial bank works, right? Every commercial bank, Capital One, has an account at the Federal Reserve. That's what gives us access to dollars. So you take that one step further, you realize that if Russia wants to buy oil from OPEC, they need to open an account at the US Federal Reserve. That's an incredible statement, right? And that's how we enact sanctions on other countries. We say, oh, you want to do something we don't like, we're going to enact a sanction. The first thing we do, we shut off your Federal Reserve account. You can no longer buy oil from OPEC. And the fact that this isn't taught in every single political class is like bonkers to me. So like I said, none of this pertains to real estate.
No, it does though. Yeah, no, it is. And it is. And now it's just even more interesting that like, it's so important, but I mean, less than 1% of people understand or even care to understand, which obviously they should, because it's very important. It affects a lot of things. And I'm just sitting here, man, I'm like, you have to, you yourself, like you got to be teaching, some kind of course or like share this stuff more, because you're obviously passionate about it. I don't know how much you use it in the day-to-day work. I'm sure you use it personally, but it's good stuff, man. Like I really, I want you to get this stuff out there more because it's very valuable, and we probably should do another podcast on it. This is like a college course right now, even better, so appreciate you sharing all that.
Yeah, no, like I said, I could get on a soapbox for a while, and you definitely get to go down the rabbit hole on it, which is kind of fun. But slowly, part of what happens in the world starts to make a little bit more sense when you get these big formative pieces that start kind of lining up.
Yeah.
But yeah, so that's kind of my bullet point on interest rates being critical to real estate valuations. The Federal Reserve is really the only thing that matters in regards to that. Commercial banks are they're subject to the pressures that the Federal Reserve sets for interest rates. So it all trickles into real estate. It's highly influenced. It's one of the one asset that you can lever up to an extreme degree, and so interest rates really impact it more so than others.
Let me ask you. This is like a random thing I saw, and I don't know if it's going to throw you off, but I don't know how I feel about it. I saw it on someone posted on Twitter, and they said like, you borrow $5 million and you work for the bank. You borrow $100 million and the bank works for you. And I was like, that kind of sounds like it's true, but like, what do you think about that?
Yeah, I'd say that's valid, and I think what it kind of boils down to is there is I don't want to say an uneven playing field, because that implies some type of malice or like calculated decisions. What I would kind of summarize that is like, who can borrow the cheapest money, right? And that's why you have BlackRock in the news right now, that's being kind of painted as the villain for buying up all the properties everywhere in the world. And when the price you can pay is determined, like I said, by what interest rate you pay, who can borrow the cheapest can offer the highest prices, and they're out competing everybody. And so in that regard, if I want to buy a single family home personally, and you pay, I don't track what they are right now. You probably have your finger on that pulse. But let's say for instance, you're borrowing at 3.5%, and BlackRock comes around with 290. They're going to be able to pay more than you. And then they're thinking about like monetizing the asset and turning it into a rental, that whole thing. But that's I agree with that, of like, borrow 5 million, you work for the bank, borrow 200, the bank works for you. it comes. Yeah, I'd agree with that.
Cool. Interesting. Yeah, I just wondered your take. Well, cool, man. This is all super, super valuable. Last thing before we get you out of here, what would be maybe a tip or things that have led to your personal success? Just like, a couple things for entrepreneurs or people that are getting started, like what's the most valuable thing for you or just advice that you would give for them to, grow their career and push things forward?
Yeah, I would say the first thing that came to mind is getting outside of your comfort zone. That's been a big kind of mantra of mine over the years, and very related to that was it's not about kind of another adage that resonates with me is it's not about who you know, it's about who you meet. And I appreciated that coming kind of as an outsider to New York, and also within kind of within Texas too. I was homeschooled up until high school and college, and so coming into like unfamiliar territory, putting yourself out there was really meaningful for me, and just meeting as many people as possible, and that was really helpful as in my time in Texas, but then kind of restarting again up in New York. And um, I think that I know that you work with a large team of brokers who might be going through something similar. I assume not all of them have already a book of business or whatever.
Mm-hmm.
They're in the throes of that, but that was a really meaningful piece of advice for me was just grabbing coffee with people who worked in the industry was monumental for me. That was one of the biggest things for the real estate program. Like you said, that confidence aspect. For me, it was just such a good window into, hey, I'm in the master's program, I want to learn more about the industry. Do you have time for coffee? And I was doing that when I was in the program. I was going to Austin, or I was going to Houston and Dallas probably every other weekend just to grab coffee and then drive back. Line up like line up 2 or 3 30-minute meetings back to back, and that was really helpful for me. Like I said, not because I ended up getting a job with one of them or anything like that, but just because you build a level of it just adds to that confidence. It adds to your, oh, I'm familiar with that topic because that guy told me about it that one time, and I have at least I know the right questions to ask to someone who now works in that industry. So that was a really big piece of advice for me, and especially for people in college who don't know what they want to get into. Just go grab coffee with people and see what type of people you like working with. What if they exist in that industry. So that was a big piece of advice that helped me out, specifically within college, but I think it kind of carries on in the professional world as well.
Yeah, that's great, man. It's that's one of the things that I do a lot. Like I'm almost like full time just meeting people, and so
Hmm.
cool to hear that. Because I know I've seen a lot of value, but a lot of people don't want to get out there and do it. And I'm a little bit more in the residential world, like a little bit more investment focused, and it's just funny. Like I try to go meet other realtors, and they're like, well, "I'm not going to meet you. We do the same thing," and I'm like, "Man." Like you don't
Yeah,
get it at all. Like that's the
you're
smallest
missing
thing.
the picture.
Yes, yes. There's so many things you can do with people. Just find good people, stay in touch, and then obviously I would imagine you really value staying in touch, right? Because you could do that coffee meeting, and never talk to that person again, and then yeah, maybe you learn something, but you're really missing out on a lot of value that you can get over the years for both sides.
Hmm. Yeah.
Well, that's cool, man. Well, this is we do a lot of these, and this is definitely one of my favorite. Very informative and a lot of good knowledge here. Is there anything else that you want to touch on, or you think is important before we get out of here?
No, I think we covered a lot of it. Yeah, I mean, the real estate industry is it's becoming a big focus for a lot of people. So it's an exciting industry to be in. I guess specifically within multifamily, it's becoming kind of a partisan issue, right? Of like rents are going up, things are not affordable, and it's interesting to see how the multifamily space is going to play out over the next handful of years as people try to put pressures on landlords. And we've seen that over COVID, right? There was there's rent moratoriums that were, obviously hard on landlords, but not a lot of sympathy for landlords in the public eye. And not saying that's right or wrong. I'm just saying that that's a trend that's happening. And one thing that I'm not sure how much people, listening to the podcast really get exposure to affordable housing, but one element that I think that's behind it is large equity funds. It's becoming an investable asset class, affordable
Yeah.
housing. And that's one thing that's a little fascinating to me, is that people are waking up of like, all these pressures are coming on their landlords. Affordable housing has already navigated this, interesting interplay, whereby we've already put rent control on our property, right? Like we're already, for lack of a better word, rent control, but we're already restricting our property's income to certain degrees, and we're getting advantages for that. And people are appreciating that it's an interesting asset class where, when your rents aren't going to increase, or that they're going to be increased in a formulaic approach, and they're always under market, that's a pretty resilient asset class, right? Like if the next recession happens and we have mass evictions, whatever, let's say market rents drop by 20%, the rents that you were attaining on your affordable, if this is your market rents and those are your affordable rents, um, your market rents can drop 20%, but that doesn't affect this slow formulaic 2% per increase per year that you signed up for to begin with. So
Mm.
I think that affordable housing, just to bring this back to, I guess, the specific industry I'm in, I think that affordable housing is going to be increasingly important because it is a bipartisan issue. Like Democrats love it because it's affordable housing. It's an expansion of the federal government, which they obviously like, and Republicans love it too because it benefits real estate developers. It's actually a good it's a good interplay between market rate developers navigating um, a regulatory program that is kind of an answer to the failures of the past, which was like, we think of like the projects, right? The projects, which that has such a negative connotation, that was the government building affordable housing themselves, and that turned out kind of like everyone knows. And then in the 80s, they came out with this, what's called the low income housing tax credit program, which kind of married the incentives of market rate developers who are building affordable housing, and the funds are provided by the government. So it's an interesting industry to work in. There's a lot of kind of brain damage involved because it's just honestly kind of dry. You're just reading regulatory agreements and to figure out how it impacts your property. But I think that it's an interesting industry. But I guess for any of your listeners who maybe in college or whatever, it kind of comes back to that element of specializing yourself. I think that this industry is one that people really aren't aware of that it even exists, but I think it's one aspect of our world that's inherently bipartisan, which is interesting, and I think it's going to keep increasing in importance over the years. So
That's
that's
fascinating.
that's just my bid for affordable affordable housing. So
No, man, that's fascinating. Really, really good. A lot to think about, and if people can, really dive in on this, I think there's a lot of value to take from the stuff you're sharing for the future moving forward. So, once again, man, appreciate you coming on. This is really great. I enjoyed it. We hope to do this again and maybe do an hour on the Federal Reserve. And I hope you keep enjoying New York, and safe travels back from Texas. And thanks again, man. Appreciate everyone listening. This is the Real Estate Podcast. It's Harrison Hunt, Origination Team, Capital One, Multifamily Finance. And you guys have a great rest of the day. Thanks.
appreciate it. Thank you for having me.